Lesson 1-3 deals with how transactions affect owner's equity in an accounting equation. So we're going to be looking at business activities that happen day to day that are going to affect our owner's equity or our capital account. All right, so what are the 4 things that affect owner's equity? We've already talked about one, investment. This is where the owner invests in his or her company. Okay, they might probably invest cash. Cash goes up, capital goes up. Another thing that affects our owner's equity is if we make a sale or if we generate revenue. Okay, if we're providing services to people, we're making money, okay, that helps to increase my worth. We call that making a sale or revenue. All right, our next one, expenses. Okay, there are things in the company that I need other people to do for me. For example, I need utilities. I need to have electricity. I might need to rent a location, rent a business. I may need to have the telephone company set up a telephone for me, and pay for that monthly fee. Okay, those things we call expenses. Okay, we pay for goods or services needed to just operate the business. Okay, those decrease my capital. Those decrease my owner's equity because I have to pay for those things. I'm not generating any revenue. Those are things I have to take out. So my worth goes down with those. So our goal is to try and decrease our expenses or minimize them as much as we can. And then our last one, like we talked about, every now and then I do need to pay myself. Okay, so as an owner, I might withdraw stuff out of the company. Okay, I take assets out of the business for personal use. Okay, we call those withdrawals. So those are the four things that are going to affect my owner's equity account. And we're going to deal with transactions and how those affect that owner's equity. The other transaction we're going to be talking about here is a sale on account or charge sale. Just like sometimes I buy things on account, I'm going to allow my customers to buy things on account. I'm going to make a sale on account. Okay, it's a sale for which cash will be received as a later date. We create an account called accounts receivable, which would be an asset because I own my customer until they pay me back. We'll talk about that more in our work together. All right, so let's go on to work together 1-3. Work together 1-3 deals with business transactions that affect our owner's equity. And again, we'll be talking about how revenue, expenses, as well as sales on account affects our owner's equity account, capital, as well as the rest of the accounts, those transactions. So let's get started. Number 1, received cash from sales. Remember, as we do these, we break it down. Received cash. Cash is an asset. Since we're receiving cash, cash will be increased. Okay, then our second part is from sales. Remember, sales is revenue. Revenue helps to increase the owner's worth. So we're going to go over here to the capital account and we're going to increase it. Their worth is now increased because they made a sale. They did all that hard work, they did their service, so now their worth goes up. So cash is increased, it's an asset, capital is increased, our owner's equity is increased. Again, we jumped over the equal sign, so we have plus over here and a plus over there. Next one, sold services on account to Bowman Company. Okay, this is a tricky one. When we see sold services, a service is a sale. Okay, we're making a sale here. So if we break it down, sold services, sale, it's a revenue. My capital account is being increased. Now on account, remember on account means no cash was exchanged. So technically, because that person, I did something for them, they haven't paid me, I own a part of them. So that's where we put into our accounts receivable account for Bowman Company. Okay, eventually I have to receive money from them. So because I own a part of them, their account is going to go up. And again, to make sure assets equals liabilities plus owner's equity, I have a plus on this side and a plus on that side. All right, so that is question number 2. Question number 3, we paid cash for telephone bill. Okay, here's our cash, paid cash, cash is going down, cash is an asset. I can't see the equal sign there. There we go. For telephone bill, remember telephone bill is classified as an expense. An expense is pretty much we have someone performing an activity for us, or we have someone else do something for us, perform a service. Here we have the telephone company making sure we have a telephone that we can answer. So because we're doing that, that affects our owner's equity, which means my capital goes down. So cash goes down, we paying cash, and capital goes down. Because I have to pay them, my worth in the company goes down, or the owner's worth. All right, number 4, received cash. Okay, again, we're going to break this down. Received cash, cash is an asset, cash goes up. Now, on account from Bowman Company, okay, we're receiving cash from a customer that had previously I owned because they had not paid me for what I had done for them. So if they're paying me and I don't own them anymore, then their account has to go down. So we put a minus there. Now again, I'm not going over the equal sign here. So I have plus and a minus, they cancel each other out, and so my assets still equals liabilities plus owner's equity. A reminder, when we do transactions, 2 accounts have to be affected. All right, and our last one, paid cash to owner for personal use. Okay, breaking it down, paid cash. Cash is an asset. I have less cash, so cash goes down. All right, and then we have to owner for personal use. Okay, Susan needs some money. She needs to pay herself. So she's taking money out of her company. Her worth is going down. So that means her capital needs to go down. And again, I have a minus over here and a minus over there. Okay, there's a lot of thinking here, and again, a lot of new words for the language of business is accounting. So we just got to keep practicing. Good luck and have fun.